So when you do get a market that starts to move in your direction and you find an entry signal, where do you place that initial stop loss? Now that is a very good question. That is a really important question because that initial stop loss starts the ball rolling for a lot of other things. With the initial stop loss being placed, you get an idea of the lot size you need to trade in order to risk a certain percent. You get an idea of where 1-to-1 or 2-to-1 is. That initial stop loss is really important. Now with that initial stop loss, you want to put it in a place where it's not likely to get hit. Now we are trend followers. I like to trade with the direction of the trend. So let's take a look at that. We'll take a look at a couple of examples. Now I'm going to get rid of this AMA in here. We're going to simply use this blue moving average for this example. This is a 100 EMA, by the way, just in case you're interested. If the price is under it, we're looking for short trades. If the price is above it, we're looking for long trades. Now this is how we're going to do it in this example anyhow. So we're taking a look at a couple of different shorts in here. What we want to understand before we even place our trade is we're looking for a trend following trade. Now that is a UBFX specialty. We are looking for the market to move with the trend. We get the biggest market moves. We get the highest probability trades that way. When we have a market that moves with the trend technically is going to produce progressively lower highs and lower lows in a downtrend. When we have a downtrend, we are going to make a high that is followed by a lower high, and that will be the case almost all the way down that trend. It will make lower lows, but ultimately in a downtrend, we're going to see that the highs are lower than the previous highs. So we want to keep this in mind. Now with an uptrend, it's the exact same, but the opposite. We are going to see that lows get progressively higher than the previous low. Now with that concept in mind, that makes these lows for buy trades and these highs for sell trades very good places to put your stop loss. Now I understand that social media has you thinking that if you place a stop loss above this high, that the market is going to come up and take you out because it can see that high. It can see where your stop loss is. And generally speaking, this is not the case. Market manipulation this way is a rare thing. It does not happen nearly as much as people want you to think it does. And if you look at the market, the way it moves, the structure it forms, you're going to find that indeed these highs and these lows are the safest place to put that initial stop loss. So in this example, I'm looking at this market movement. We are seeing the price drop down, pull back up, and then continue to move down. So what we're looking at is in this area here, we're looking for that short opportunity. When we get that short opportunity, it may be this candle. And then with this candle being our entry, we are going to look at the most recent swing high, and that is right here. So we see the most recent swing high there. Now with that short entry, this is where we enter. Our stop loss is going to be above this swing high. It's not going to be on the swing high. We do want to let the next few candles have a little bit of room to do what it does. So having our stop loss right on that swing high does become a little bit dangerous. I do like to have a bit of a padding, a bit of a window. So I've got this space between the high of that swing high and my actual stop loss. Same thing is going to happen in here. I'm going to have a bit of a space between the stop loss and the swing high. Now, how many pips that space is going to depend entirely on the time frame and the market volatility. The Euro USD is not going to have as big candles as the pound Japanese yen, for example. So I'm eyeballing this. Now, I know that's not very scientific, but that is generally how I do this. I'm looking for a comfortable space between the price and my stop loss. And if I were to take a long trade down here, my stop loss would be something like this. I'm looking for a comfortable space that's not too far away, but also not super close to the price. So let's take a look at the market moving up. We have an area where the price pulls back and it gives us a signal to go long. In this area, we may be looking to take a long trade right here. As this trade happens, I'm looking for the most recent swing low, and that is going to be this low here. That is going to be this low here if this is the entry to go long. That is going to be this low here if this is the entry to go long. So I'm looking at the most recent swing low because that is the safest place. The market is going to do this. It is going to make progressively higher lows in an uptrend. Now, we don't have to have our stop loss that far away. If we want to bunch it up a little bit, there is a way that we can make our stop loss even smaller, but still be fairly safe. there's something called a 1-bar stop. And with a 1-bar stop, what we're looking at is that entry candle, or the signal candle, being the location where we will place our entry and our stop loss. And this gives us the ability to keep our stop fairly tight. When we have a candle, let's say this is our candle here, this white candle, our entry would be just above the high of that candle. And being a 1-bar stop, our stop loss would be just below that candle. That tightens up the stop loss. So we would have our stop loss sometimes cut in half. So instead of risking 20 pips on this trade, we might only be risking 10 pips. Now, the nice thing with having a smaller stop loss like this is the market does not have to move quite as far to give you a 1-to-1 or a 2-to-1 or a 3-to-1 trade. With a smaller stop loss, we're able to have a smaller market movement, give us more profit. So this 1-bar stop is a nice alternative. Now, it is a little riskier, of course. You're a little bit closer to the price movement and you may get stopped out. But I find with a 1-bar stop, the risk to me is generally worth the reward. All right, so if I'm looking at this candle here, this candle gives us that short. We looked at this, we're looking at selling it right in here as an elimination trade. Originally, the stop loss would go above this swing high, but instead, we're going to take a look at the candle that gave us that signal. This would be the candle. The high of that candle is just here. The stop loss is not quite cut in half, but it is substantially smaller. So instead of a 1-to-1 being down here, my 1-to-1 is now here. So I don't need the market to move quite as far in order to make this trade profitable. And with a smaller stop like this, we can get more out of the trade much easier. The market doesn't have to move quite as far for us to make a 2-to-1 or a 3-to-1 type trade. So we've looked at the swing highs and the swing lows, which is the best way to place your stop loss. We've looked at the 1-bar stop, which is not a bad way to place your stop loss. This is going to keep your stop fairly close and fairly tight. Another way is with an indicator that I have called the dots. And I'll show you how to build this one. This is the dots indicator. The UBFX group uses this quite a lot. What we're looking at is the dots switching sides. This dot indicator is going to give us the position for our initial stop loss, and it's going to give us a way to trail that stop as well. Now, the entry we'll say is on the close of this candle. So we get our entry just below the low of that, and our stop goes just above the high of that dot. The dot has switched sides, giving us a fusion trade. So now we've got this nice clear signal to go short. And if the market gets to our target, of course, it'll be closed, but it also gives us a way to manage the trade in case we get a pullback that takes us out. Now, the way that you can do this without the actual dots indicator is by drawing a moving average channel. This is a 13 EMA of the highs and of the lows. Now, with the dots, I do shift the EMAs over by one. So if I'm adding a couple of indicators to the chart, I will build that. The first moving average is going to be an EMA, going to be set to 13. It's going to be of the high. And like I said, I do shift it by one. And the next EMA is going to be the same, but of the lows. So we're looking at a 13 EMA of the lows. Again, I like to shift by one. And what we see is an overlay of these dots. We've got the dots on the chart and we can see how they're poking through that moving average. This is a 13 EMA moving average channel, which creates the dots. And with this 13 EMA moving average channel, let me just get rid of the dots entirely. This gives us a nice way to position our stop loss. So if we're looking for a short trade in here, our stop loss can go just above that moving average channel. If we're looking for a long trade in here for whatever reason, our stop loss can go just below that moving average channel. And as the trade progresses, our stop would be managed along that moving average channel. Now, you can use different settings for this, of course. One of the other settings that I really like is an 8 SMA of the moving average channel. These are the three different ways that I would consider positioning my stop loss. Again, using the swing high and the swing low is the best way to do this. If I am using the market swings to position my stop loss, I am in what's most likely the safest place. If I'm using the swing highs in the sell trade, these become the safest places to position my stops. If I am using the swing lows, let's scoot over here, delete those. If I'm using the swing lows, these become the safest places to position my stop losses. It is not normal for the market in a trend to come back and tag your stop loss no matter what you've heard. If our stop loss is placed and it does come and tag us out, then that's what happens. That's part of trading. We are going to get stopped out no matter where we place that initial stop loss sometimes. we could place that initial stop loss here, and eventually we're going to find a trade that tags us out right at that stop loss. If we make it a little bigger and place it way down here, we're going to get into a trade at some point that does touch that stop loss and takes us out. We are not going to find the perfect place that will never get tagged. So with that being the case, I am going to position my stop loss in the highest probability for a successful trade that keeps the stop fairly close to that entry and gives us the biggest opportunity for a 1-to-1, a 2-to-1, or a 3-to-1 kind of trade. All right, I hope this makes sense. Using the swings is the best place for initial stop loss, but there are other ways. The 1-bar method is a favorite of mine, and I do use that a lot, and it will tighten up your stop loss, allowing the market to give you more with the same kind of movement, simply because you are able to risk a little bit more on the trade if you're risking a certain percentage of your account. And you'll know really quickly if you are in the right trade, because if you are in the wrong trade, you'll get stopped out pretty fast. And from there, you just place the next trade and you'll get your 2 or 3 or 4-to-1 and recover that loss with very little problem.